Do you know how to choose the right commodity to trade? The commodity markets are crucial to commerce. Choosing the right commodity to trade requires knowing why a commodity might move, and the liquidity available to trade that commodity. But what are commodities? Commodities are essential goods used in commerce that are interchangeable with other goods of the same type. Commodities include crude oil, natural gas, gold, silver, corn, and wheat. Commodities are physically exchanged, as well as traded on regulated futures exchanges. Let's learn few basic terms for commodity trading now. What is physical commodity trading? Physical commodity trading is the buying and selling physical goods such as oil, gas, metals, grains, and other raw materials. It involves purchasing and selling commodities for imminent delivery or future delivery. Another form of physical commodity trading is arbitrage. The merchant can generate an arbitrage if the purchase price plus transportation and storage are less than the sale price. What is a futures exchange? A futures exchange is a central marketplace where buyers and sellers of futures contracts can meet to trade. The most commonly traded futures contracts include crude oil, natural gas, gold, silver, copper, corn, and soybeans. Some futures contracts are physically delivered. What is over-the-counter commodity trading? Over-the-counter, OTC, commodity trading is buying and selling commodities through a network of dealers instead of on a regulated exchange. Large institutional investors, such as hedge funds, often use OTC commodity trading to gain exposure to commodities without going through the exchange process. What is contract for differences commodity trading? Contract for difference, CFD, commodity trading uses financial security to invest in a commodity. A CFD is a financial security that tracks the underlying movement of certain commodities. What is a commodity exchange traded fund? A commodity exchange traded fund, ETF, is an investment fund that tracks the price of a specific commodity or group of commodities. Commodity ETFs expose investors to the price movements of commodities without having to buy and store the physical commodity. What commodity trading strategy should you choose? Since several different instruments and platforms are available, you need to choose the one that fits your accessibility and trading style. For example, physical commodity trading requires a lot of capital, as it requires you to purchase and store a product before you can transport it to another location. Fundamental and technical analysis. Financial securities such as CFDs, ETFs, and futures contracts allow investors to use the risk management and a trading strategy to enter and exit commodity markets without the headache of physical delivery. Technical analysts might also use statistical studies, such as trend following and momentum. Popular trend-following strategies include a moving average crossover. Momentum indicators can also tell you when a commodity is overbought or oversold. There are also several types of trading strategies that you can use to trade commodities. Before pulling the trigger on a commodity trade, ensure you find the security and platform that fits your trading style. Thanks for watching. If you find this video helpful, please subscribe and hit the like button.